can go to the start if you want.
Welcome, everyone. We're going to call this meeting of the Police and Fire Pension Board to order, and I will start by reading our land acknowledgement. The City of Albany recognizes that we occupy the land originally protected by the Confederated Villages of Lashon. We acknowledge the genocide that took place on these lands and must make strides to repay the moral debt that is owed to this indigenous people, specifically the Albany tribe. We thank them for their contributions, which have transformed our community and will continue to bring forth growth and unity. The City of Albany commits to sustaining ongoing relationships with the tribe and together build a better future for all that now make this their home. And should we have a roll call?
Yes. Board Member Ford is absent. Board Member Murphy? Present. Board Member Tiedemann?
Here.
Board Member Weitzel?
Here.
And Board Member Sue, myself, is here.
Great. That will move us to the consent calendar. Consent calendar items are considered routine and will be enacted by one motion unless there is separate discussion requested by a board member or a member of the public. Does anyone have any of these items they wish to discuss separately? Anyone from the public? I will move that we approve consent. Is there a second?
I'll second.
Thank you. Should we have a roll call?
Board Member Murphy?
Yes.
Board Member Tiedemann?
Yes.
Board Member Weitzel?
Yes.
And I vote yes. So the motion passes.
Thank you. That brings us to our open public comment for persons desiring to address the board on items not on the agenda. Are there any members of the public wishing to speak?
No.
Any staff and board announcements?
No.
Seeing none, we'll go to our reports, which we have one report, which is Dewey 2 of CIBC presenting on the investment report for the quarters ending September 30th, 2023. Thank you for being here.
Thank you, everyone. So it's a quarterly review of the third quarter performance report for the pension portfolio. If you go to tab number 1, it's the asset allocation. So that, if you go to the next page. Next page. There we go. So this is as of the end of the quarter, September 30th. This is the portfolio, about 12% in cash, $250,000, $252,000 in cash, about $901,000 in bonds, fixed income, or 42% of the portfolio, and about 47% in stock equity, mostly U.S. stock, so $1,015,000. The total balance at the end of the quarter was $2.169 million. You go to the next page. This is the change in value for the quarter. At the beginning of the quarter, the portfolio was $2.47 million. Net withdrawal was $300,000 transferred to the operating account. Income generated was $16,705. The capital appreciation or change in value, which is just the change in price of the fund that we invested. So it was down $21,278. So the total return is the income plus the capital appreciation, which was negative $4,573, giving the ending balance at the end of September 2.169. If you go to the next page, this is the change in market value since inception. So since we started managing the portfolio back in September 2009, the value at the end of September was $10.9 million. Over the years, about $15.1 million withdrawn from the portfolio. Income generated was $2.34 million. Capital appreciation, so the gains over the years, a little over $4 million. So total returns over the last 14 years, $6.38 million, giving the value at the end of September, as we discussed. You go to the next page. This is the performance summary of the quarter, of year to date, last 3 years and since inception. So year to date, the portfolio generate 4.15% return. Last 3 years, right around 6.68%, and since inception, about 6.57% over the last 14 years. So even though this kind of paint the picture of the investment over the long term, the target for the portfolio, as we've been talking about, is a balanced portfolio with half bonds and half stock, bonds and cash and half stock. So over the years, the target return has been in a 5.5% to 6%. So the last 3 years kind of really give a better picture of how the portfolio performed during a down cycle and then a recovery. Last year, as you may remember, we had a significant sell-off in equity market stock. The U.S. stock market, the S&P, was down about 20% from the beginning to the end of the year. The portfolio took a slight hit because of the bonds we own in the portfolio and equity that was more value-oriented, so it outperformed the S&P. But over the last 3 years, we had a significant sell-off. We have a really good performance in 2021, a significant sell-off in 2022, and then a little bit of recovery so far this year. The portfolio still average out right around the target that we set out for the pension. With this, if you look at the equity alone, so last year or the last 3 years, fixed income was down 3.29%. Equity was up 16.45%. The reason for it, and this is the big thing about last year with the rate, the Fed raising interest rate. As interest rate move up, the prices of the bonds went down, and before last year, we had bond yield was very low. So average return before the Fed rate hike for the 10-year before that, average return on bonds was just about 2.5% to 3%. With this past year, when bond prices went down as interest rate went up, it shows in the average return in the last 3 years. But so far this year, the bond interest rate continued to go up, but this is where the interest on the bonds, as the bond mature, interest begin to pay out higher, and that's kind of accumulated from here. So the next few couple pages are the holdings in the portfolio, where the cash is, the bonds fund, and the stock fund. If you notice, there's about $240,000 in Schwab money market fund. This is when we raise cash to make the distribution, the $300,000 for the pension. We raised a little bit more than that. The reason for it was, as interest rate, we expect interest rate to continue to go higher, slightly higher, and bond valuation will be more volatile. So from now to the end of the year, in projection for the pension withdrawing more money, we took advantage of the market, raised the cash and put in money market. Right now, money market cash yield was about 5%, right around the target that we set out for the pension. So while we sit in cash, the amount still earns right around a little over 5% interest, without taking the volatility of stock or bonds, and that's the reason why we have more cash than normal. We talked a little bit about bonds. The stock fund has done very well. The Dodge & Cox stock fund, showing in the performance over the last 3 years, up 16%. This fund is more in the middle of the growth and value kind of bucket. So in the years where growth stock outperform everything, the fund underperformed, but the fund made up for the performance in a year where the market was more volatile, specifically last year and earlier this year. So that's a summary of the portfolio where we are. Any questions, concern? We'll move on to our firm's economic outlook. So this is a summary of where the market is year-to-date heading into the fourth quarter. As you can see, the U.S. stock market, basically the S&P was up 13%. Long-term Treasury, it's the bond U.S. Treasury was down 8.5%. And that was basically the interest rate move on all of the long-term Treasury, 10 years, 15 years, 20 years and above. So at the beginning of the year, 10-year Treasury was right around 4%. Right now, it's about 5%. So if interest rate move 1% up for a 10-year bond, typically the rule of thumb is the bond price would drop about 10% to account for the rise in interest rate. And that shows in the performance or the return of long-term Treasury. The interesting, or not interesting, but if you look at commodity is kind of the gauge for inflation. So far this year, inflation has been trending down. You follow the news, the market still, overall, inflation is still very high comparing to where the Fed target is. The Fed target is 2%. Inflation is still right around 4%, which is high for the Fed, and that's the reason why the Fed still had a very restrictive position, maintain the higher rates for longer. But comparing to where we were exactly this time last year, inflation was around 8% this time last year. Right now it's 4%, so it's continued to trend down, which is a good sign, but we still have a little bit to go to get to the target of 2%. This is our investment theme. So looking back for the first quarter of this year, U.S. economy has performed really strong, stronger than expectation going into this year. If you remember the last few quarters we talked about, the expectation was U.S. economy would head into a recession toward the end of this year. And the leading indicators going into 2023 was showing that the economy was heading into a recession. We not only didn't have a recession, the economic activity was actually quite strong, that there was growth in the last couple of quarters. Though if you follow kind of leading indicators are still showing that historically when you see these kind of indicators, a recession is expected within the next 12 months. And so we're right in that period. Our firm view is we believe that we may have an economic slowdown, but we may not see a severe recession. And there are a couple of things. The Fed maintained their stand for higher for longer to fight inflation, so interest rate will remain high, but the positive sign is consumer spending continue to be strong. Labor market is healthy. Those are the two things. Consumer spending, it's about 70% of the economy. As long as the consumer maintain their jobs and earn an income, spending is unlikely to be severely cut. And that's our expectation, that we may see a little bit of a pickup in unemployment. That's natural for higher rates and corporations start to cut back. But it's unlikely that we're going to have a severe recession based on the current economic fundamentals. So after the strong first half, stock market kind of gave back some of the gains in a little bit in September and in October. Seasonality, September and October are just really tough months for the market. Historically, there's really no reason, no explanation why September and October market performed poorly, but historically that's how it happened. But we believe as we head into November and December, earnings have been very positive. So as corporation continue to report better than expected earnings, the market could set up for a rally into the end of the year. And our view is with our expectation that inflation continues to go down, at some point the Fed will, the lagging data will show up and the Fed will change their course, and that would set up for a longer term bull market to form. And the timing, we're not 100% certain, but it could coincide with if we have a slowdown in the economy that point to a recession and Fed start talking about cutting interest rate. That's where stock market can form a bottom and move up, setting stage for a new bull market. A couple of the next slides, I talked about the U.S. economy. Yet the consumer saving is still strong, but the biggest thing that we follow is savings through COVID. The COVID spending or stimulus saving has been depleted. So the level of consumer savings or household saving is back to normal trend line before COVID happened. So in terms of the consumer situation, weaker condition ahead, there are signs that we're heading into a recession like I talked about, but how severe it is, our view is it's not as severe as previous recession that we experienced. I'm gonna skip the next page. U.S. equity, page, sorry, go one more page. This is kind of, we talked about the return on the S&P comparing to the overall portfolio. The S&P so far this year was up 13%. This kind of show why kind of the broader market didn't perform as well. The largest, this is if you look at this chart, the data is on September 18. It showed the largest 15 companies of the S&P give about 42% average return this year. If you look at the overall index as of September 18, the index itself was up 17%. So if you take out the largest 15 companies, you're going to about 4% return on the S&P. So the market overall this year has been quite very concentrated. The largest companies give a lot, basically dominated the return, while the rest of the S&P 485 companies only average about 4%. If you don't own any of these companies, you're guaranteed to underperform the S&P. Now, the fund that we invest in there are a number of companies in there that are in the largest 15, but the biggest ones, or the ones that give the most return, NVIDIA, the companies that the market is focused on in artificial intelligence. They make chips for artificial intelligence. NVIDIA was up about 200% for the year, and that's kind of drove a lot of the return for the S&P as well. So if you don't own NVIDIA, it's a guarantee to underperform versus the market, the S&P index. But that's just the period where we are comparing to the previous 3 years. X out NVIDIA, the portfolio, the fund that we invested in still outperform the S&P, the overall market. If you go to the next page, this is, we talked about earnings expectation for this year and next year. So back in if you look at this chart, in 2022, this is corporate earnings. Corporate earnings grew about 5% in 2022, while the market continued to go down. That was when the market went down, it was more on the adjustment for interest rate. As interest rate go up, valuation of companies have to come down, but earnings continue to grow. Going into this year, we expected corporation to cut back on slow down in corporate earnings. So the forecast was to be up 1%. So far in this earnings cycle, companies have been reporting better than expected numbers. Right around 60% of the companies reported have reported positive, better than expected numbers. What's interesting is analysts and corporate forecasts for 2024 earnings to grow 12%. So this is our view is it's a little more optimistic than we anticipated. If it's actually happened that companies could grow 12% in corporate profits, the S&P or the overall market could perform very well, even though there are signs that the economy may head into a recession. Corporate earnings growth can sustain the market, during a recession, and that could set up, like I said, it could set up for a new bull market cycle. I'm going to skip the country focus and private equity. The last page is our asset class views. So we haven't changed our view in terms of the asset class. Global equities, we still have a neutral view, and that's more in line with where we are in the cycle with interest rate, where it is. Valuation in the market is quite full. It was a little expensive in August, heading into September, but in September we have a sell-off, and in October we have a little bit further sell-off. So valuation right now it's right in a normal range of where we're looking at historically. It's not too expensive, it's not too cheap. So we have a neutral view. Fixed income and cash, we have an underweight. It's still because of expectation that the Fed still had a little bit room to go with interest rate. However, with the long-term interest rate moving up the last month or so, we believe going longer in fixed income makes a lot of sense. And it's becoming a lot more attractive comparing to where we were just about 3 months ago. And that's it. Any questions, concern, comment?
So you were saying for the 2024 year, you're expecting significantly less than this year, correct, as far as a downturn in the economy?
It's hard to say, of course, but based on the expectation of earnings growth, where valuation is right now, we expect 2024 to be positive.
Okay. So, and I'm just looking at that graph there.
Yeah.
All right, yeah. So next year it's going to be positive like at the third or fourth quarter, or you're expecting it the first quarter we're going to start to see an uptick and all that?
It all depends on if we have, when you look at the quarter by quarter is more on the trading, short-term trading technical.
Right.
It all depends on if we have a significant rally in November and December. Typically, if you have a rally in November and December, going into the first quarter of next year, you have a little bit of give back of the gains and repositioning of the portfolio. But then, you head into a summer and then the market will react differently. But if we, just like last year, in November and December, we have a sell-off, we have a low in for the market set in November, and then it's a little bit of rally, and then give back some of the gain in December. In January and February, we saw a significant rally from the bottom. So it's more short-term trading positioning of the funds.
With the Federal Reserve, you're probably a quarter basis point, maybe?
That's the expectation. They put out the dot plots that there's one more rate hike of a 0.25% still left to go in terms of the Fed's expectation for the next 6 months. The Fed has come out and said it's all based on data. They have to look at the data. It's the expectation because of data continue to show hotter than expected inflation, or it hasn't come down as quickly as they wanted it to be. If we see over the next months that there softer data in employment and not as hot inflation, the Fed may just be done for the year or next quarter.
Thank you.
Anything else? All right, thank you so much, and I look forward to seeing you again next quarter. Oh, January, yes.
Thank you.
All right, thanks.
That brings us to our discussion items. First, we have 6.1, which is a pension calculation adjustment.
So this adjustment is, it's not an actual adjustment going forward. It was simply an item that was miscalculated the last time it was brought to the board, and it was rectified ahead of the pensioner receiving that pension. It was caught during review. So this is mainly to bring the actual calculation in front of the board for review and approval. Didn't. Yeah, if you could. I actually can't. My computer's not on, so I have no way to go over the detail of it without it. So this is, when we do these adjustments and we issue the checks or the ACHs, these are mailed to the pensioners. And this is what the pensioner received, but it is not what was brought to the board. I believe this was, can't remember what meeting this was brought to because it went into effect in July. But the miscalculation was presented to the board at the meeting, I guess it would have been in June. Was that the one for the July increases? So this is the correct amount that was not only paid to the pensioner on time, but this is the letter they received, and it is different information from what was presented. Didn't have much more, unless there's questions on this particular item.
Just so, because we caught this before anything really happened, this is just sort of.
Yeah, it's just because, again, when the calculations are brought, the board reviews them and approves them, and this is different information from what was actually reviewed and approved. So we're just bringing it back to make sure that the correct information is brought to the board.
But we implemented the right things.
Yes, yeah, it was caught during the review before the payout was sent, and this is the letter that was sent with the July pension. So there was no need to do retro pay. They weren't underpaid at any point.
Great. Any other questions? If not, I'll move approval. Do I have a second?
Second.
Thank you. Can we have a roll call?
Member Murphy,
Yes.
Member Tiedemann,
Yes.
Member Weitzel,
Yes.
and I vote yes. So the motion carries.
Thank you. That brings us to item 6.2, which is organization of an officer. We need to elect a chairperson. Do I have any volunteers?
Well, I guess Member Tiedemann reminded me that this is actually the last meeting for the year, and in January, we may have new members. This item will be brought to the council one of their January meeting to designate the appointee and the alternate, so we may have new members. So we could elect a chairperson this meeting, or we can just table this until the next meeting to elect chair and a secretary then. Yeah, with the possible change in membership.
Yeah.
Okay, so I'll move to table the item, to postpone the item to January.
I'll second that. Has been moved and seconded. Please have the roll.
Member Murphy,
Yes.
Member Tiedemann,
Yes.
Member Weitzel,
Yes.
and I vote yes. So the motion passes.
Excellent. That brings us to future agenda items. Are there any board members who want to announce requests for future agenda items?
Just the organization of the chair and the secretary for January.
Good. Any others? Any members of the public? None. That brings us to our next meeting. Will be Tuesday, January 23rd, 2024 at 3 p.m. And with that, we are adjourned. Thank you, everybody.